There's been a huge rise in the stock market, but I'm telling you, there are 3 reasons to be extremely bullish from here. I got that coming up. My name is Mike Bernard. I am the host of the Wise Money Show. I'm also one of the CFPs right here at Korhorn Financial Group. If you're new to this channel, make sure you hit that subscribe button. Every single business day, I am coming to you with a financial nugget, usually something going on in the financial world, and then helping you apply it to your financial life. So make sure you subscribe to this channel, hit that notifications, and smash that thumbs up button. All right, so here we go. I have been skeptical of this sudden market rise over the past 2 months. I have been. There's still reasons to be skeptical. But guys, there are very, very tangible reasons to be optimistic about the stock market. Some extremely bullish signs, and I'm going to lay them out for you right now. Most importantly, tell you how to apply it in your financial life right now. The biggest reason why I am bullish right now is take a look at this chart. This chart shows the overall stock market, the S&P 500, over several decades, overlaid with an inverted graph of how unemployment has moved. And it's inverted so that you can see how they correlate to each other much easier than if it wasn't correlated or wasn't inverted. But so look at this. During the extreme times in the stock market, see those big dips right there? Notice what also is happening with unemployment. The bottom of the stock market and nearly every big dip coincides with the bottom, with the worst of unemployment. They coincide. Okay, and so normally, if you were to draw a conclusion from this chart, you would say the stock market bottoms about the same time unemployment bottoms as well. Well, guys, take a look at this past spring. I told you I've been skeptical. Even I think it's extremely unlikely that we will have unemployment numbers get worse than where they were a couple of months ago. It is extremely unlikely, even though we've got coronavirus cases rising, but the president has said we're not going to go on full lockdown again. Each community is taking it kind of one step at a time. It is extremely unlikely that we're going to go to full shutdown again. Therefore, it's extremely unlikely unemployment will get worse than the unprecedented numbers that we had a couple of months ago. Therefore, we've likely seen the bottom of unemployment, which means we've likely seen the bottom of the stock market. Very, very unlikely based on this chart, which seems extremely, extremely reliable. Very unlikely that we're going to retest the lows in March. So if you've been cautious like I have, if you've been skeptical like I have, look at this chart. There's a reason for optimism, reason for bullishness on the stock market. The second reason for bullishness is the unprecedented measures of the Federal Reserve. We've talked about it here before. The big idea is the Federal Reserve is unleashing everything they've got to apply liquidity into the economy. They've taken their balance sheet from about $4 trillion and nearly doubled it up to about $7 trillion. I talked recently, maybe a couple weeks ago, about how the Fed plans to inject another $4 or $5 trillion of liquidity into the economy, expanding their balance sheet to nearly $12 trillion by the end of the year. I don't know if that's rumor or not, if their plans have changed or not, but that apparently is in the works. If you look at how the Fed's balance sheet coincides with the drop in the stock market and the recovery, you would look and say, well, of course, the stock market is reacting and responding to the liquidity in that's created by the Fed. And if the Fed has no plans of kind of retracting that or taking that back anytime soon, there's reason to be optimistic about the market. It is very unlikely the stock market will retrace these lows if the Fed is continuing to be very, very liquid and pump liquidity into the economy. So that's the second reason, and that goes back to the age-old investment saying of don't fight the Fed. Hard to be pessimistic, hard to expect that the market is going to drop back down to the March lows with the Fed being so aggressive, and this chart displays that. And then the third reason is really a contrarian view, but I believe in it very, very wholeheartedly, and that is overall consumer or investor sentiment. When the average investor is very, very bullish, there's reasons to be fearful. When the average investor is very, very bearish, very negative on the market, there's reasons to be optimistic. Right now, we have significant bearishness. The investor sentiment as a whole is very, very skeptical, just like mine. So there's lots of reasons why investors are concerned about the market, and that very, very likely means there's a lot of upside still ahead in the stock market. What that means, if the average investor sentiment is negative, is bearish, it means a lot of people have money on the sidelines. Therefore, as prices go down, if they do, it's likely to be temporary because that money will come in off the sidelines, jumping into the market, bidding prices up. Investor sentiment is a third reason to be very, very bullish about the market, because investors as a whole are very bearish. And this tends to be a very contrarian view. When investors are optimistic, that's reason for you to be cautious. When investors are cautious, that's reason to be optimistic. And right now, they're extremely cautious. Based on a chart that I saw over the weekend, these are some of the most cautious signs ever in investor sentiment. So there you have it. Those are very, very real, three very tangible reasons why the market, you should be extremely bullish about the market in the short term. Now, with those three reasons, what do you do with it? What do you do? Does that mean you need to all of a sudden jump into the market if you've had money on the sidelines? I would argue no. Here's the deal. All of this continues to come back to your overall financial plan, your overall financial situation, what your goals are, and your current resources, and how you align those two, okay? So your short-term dollars, money that you're gonna need in the short term, should still be very cautious. It's your long-term money. If you've been cautious with your long-term money, sit down with your certified financial planner, check out your overall plan to see how much risk you need to be taking to reach your goals, and then figure out an approach, figure out a plan to get those long-term dollars invested in the right risk level as soon as possible, okay? Chart out a course with your CFP. For us, even though I've told you, I personally am still quite pessimistic despite these very, very bullish signs. We have a momentum strategy here that will adapt to changing economic conditions. Is it perfect? Absolutely not. Has it done extremely well this year? Extremely well at navigating what's ahead. And that our strategy, our momentum strategy, is very cautious at the moment. So sit down with your CFP. Your short-term money should be short-term. Your long-term money should be invested appropriately for the risk for your goals. And if that money is currently low risk and it's supposed to be higher risk, figure out a plan to get there. All right, there you have it. Contact your CFP. If you don't have one, want to reach out to someone on our team, you can do so. Find us online, corehorn.com. That's Corehorn with a K. Or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.